Hey everybody, what is up? Welcome back to Funnel Trade. This is a video a long time in the making. I've had a lot of discussions with patrons over time, and I've done a lot of contemplating on the subject myself. And is the idea that as you invest in different types of markets for longer periods of time, and especially as you have more success in it, your philosophy on investing changes. The kind of lessons you learn inform what kind of investor you're going to be going forward. And so finally, I've taken about the last 10 days to scratch out a lot of notes of things I want to talk about in this video. I even considered writing a script and just reading it from a teleprompter, but that's not really my style. I do better just ad-libbing. So I am going to start talking about the 3 levels of investor, and really 3 levels is arbitrary. You could cut it into more levels. You probably really couldn't cut it into less. At least I don't think so. But you could definitely cut it up into more and just spread out the kind of lessons and the ideas between them a little with a little less concentration. So, one thing that I'll say as kind of a ground rule before we get started here is you may get upset at this video. And I would encourage you to have an open mind. Often we tell people that appeals to authority are illogical, but there is kind of a reality that if someone is an authority on a subject, they probably know more about that subject, as long as they are a legitimate authority. Typically, appeal to authority breaks down when the person is not really an authority. And I will say that in my early 40s, I am on the cusp of jettisoning my professional career as an engineer in order to open a game store, because I've been successful investing over the last 20 years. I've learned a lot of lessons from it, and I've been able to employ them very effectively. So I will say, have some patience, listen to the whole video, and try not to get upset, because there will be some sacred cows getting gored here. And there will be some things that I say that maybe strike a little too close to home. And keep an open mind, is what I'll say. I'm not here to insult anyone or hurt anyone. What I'm trying to do is get people to understand that if you are patient, if you make a plan, and you follow it without emotion, then you will do well in the long run. And that's really the biggest lesson of all of investing. And so let's talk about level 1 investors. And, I should have thought up some cutesy names for them, like Padawan or something like that. The level 1 investors, they are typically going to be younger, less experienced at investing, potentially less experienced in the world as a whole, though I have known people in their 60s who were level 1 investors, not because they were bad at investing or they were stupid or anything like that, but because they just never got into investing until later in life. And they will typically have lower amounts of overall wealth. And one of the things that really drives them is the question of how much can I make? When they talk about making bets in markets, they're always looking at the upside. If I buy this scratch off, what's the maximum jackpot? If I buy these singles, how much could they go up? If I buy this stock, what will the quarterly report cause the price to increase to? They almost always just think about the upside because they view markets in general as places to make money. They're not really cognizant of downside risks, of the fact that markets can go down, for long periods of time. In general, they will chase yield, and that is in terms of, say, asymmetric bets with very, very low chances of very high payouts, like literal lottery tickets, or maybe it's like opening a bunch of DM22 booster packs, and they're looking for the Lotus and, a foil version of the Lotus to pay for the box. Something like that. Or it could be chasing yield in the more traditional stock market sense of they buy a bunch of stocks that have dividend yields of 10 and 12 and 14% without understanding why stocks get those kind of dividend yields. And I've seen cases where people have bought what is essentially a mineral trust. So there's these situations where maybe a large piece of land has a whole bunch of oil underneath it. And what'll happen is a company will acquire the rights to those minerals. They will package it up into a security, chop it up into shares, and sell it. And those securities, those shares, come with a dividend that's paid by actually extracting the oil from the land and selling it into the market. And so people will see that with a very high dividend and they'll buy it because they're chasing yield. Now, the thing they don't really understand at the start is there is only a finite amount of oil under that piece of land. And essentially, from day one of trading on that security, everybody is playing a game of chicken on how long they are willing to hold the stock to gain the payouts from the mineral wealth in comparison to the loss of capital of the value of the shares going down. And so that's an extreme example of where people chase yield, but they end up losing their butts of depreciation of their capital. So people in level one, they tend to be the types who are the flippers lined up at GameStop at 7 a.m., the people ducking under the roll-up door at Costco to sprint in and grab a couple of boxes because, again, how much can they make? If they grab that, Flowing Waters 151 box from Costco, how much can they flip it for on Facebook Marketplace? That's all they're thinking about. They're those kind of people who go through that kind of effort, and really, in some cases, that kind of danger when folks are pulling guns on each other in Target to get some Pokemon cards. As a level one, occasionally they do win big. And I remember when I was a level one back in the mid to late 2000s, I took a position in Take-Two Interactive, which is the company that makes the Grand Theft Auto games. And so they were going to be, I believe, releasing their next Grand Theft Auto game. It may have been San Andreas. It may have been that long ago. I think it was that they were going to be releasing the game, and so I was anticipating that it would go up very well on the back of releasing the game, that the sales would be good. So I bought a bunch of the stock, and then they got a buyout offer from someone else, I forget who, and the stock spiked. And I mean, I literally, when I got home that day, I sold the stock immediately because it had spiked up and I had won big. You know, occasionally you do. And when you're a level one investor, you're making a lot of bad choices, but occasionally you do win big. On average, though, level ones underperform the market, and there are a lot of reasons for that. A lot of it comes down to just lack of patience, and that's why I said at the beginning, patience is the best thing you can have to be a successful investor. Your level one investors, they tend to have no introspection. They think that making money is really easy. You know, they'll talk about, you know, stonks go up, line goes up. That's the joke, you know, kind of making fun of them that, oh, well, markets only go up. Often people come to this hobby, though investing shouldn't really be considered a hobby. Often they come to it because the market is in this raging momentum bull run, and they'll come into the market. And so all they've ever seen since joining the market a couple weeks ago is prices going up like crazy. And so they really think that making money is so simple. All they have to do is be in the market. All they have to do is buy the Pokemon boxes. All they have to do is be at GameStop at 7 a.m. All they have to do is grade every card. All they have to do is buy AMC and just keep buying. Crazy stuff like that. And they haven't had the time in the market and the experience yet to realize easy money is not simple. It's not easy to make a lot of money in the short term. They are impatient to their own detriment. And, you know, these are people who will be constantly updating the price of assets on their Schwab app, looking at their account, seeing, hey, what's it done in the last hour? In my first job out of college, I had a mentor they assigned me to at the job, and he literally, every time before he walked away from his desk, he would tab over to his brokerage account and look at what the balance was. And then he would make some comment like, I'm up 600 for the day, what was the daily change, or I'm down 300. But he was literally looking at it before he got up from his desk every time he needed to go out to the shop floor for something. These people have no concept of market cyclicality because, again, they haven't been in the market long enough. They haven't ridden through an entire up cycle and then the down cycle and then back up again to see the cyclicality of the market. And the cyclicality is something that, as you become more experienced as an investor, it's something that gives you a lot of reassurance that the plans you're making are going to work. They think that the market goes up and they'll just sell high, and that's all there is. The market just goes up, right? They prefer cheap over quality. And this is one that I see so often. I've seen it so consistently over the last 20 years, and I've seen it in so many different markets. Cheap over quality. People will think that, well, it feels kind of bad to spend $1,000 on 1% of a Bitcoin, because when you check your balance, it'll say you own 0.01 Bitcoins. Maybe it's a lot more fun to buy 10,000 Dogecoins, even though Dogecoin is garbage and is never going to do anything. But they like those big numbers. It's the same thing that attracts these early investors, these level ones, to penny stocks. Instead of buying a single share of Amazon, what's Amazon? I don't know. Is it still like $3,000, $4,000, $5,000, something like that? Instead of buying a single share of Amazon, they want to buy 100,000 shares of some penny stock to a company that may not even really exist. Because in their mind, what they're thinking is Amazon stock went to $2,000. Well, Craigco, it could go to $2,000 and I'll own 10,000 shares. And that's kind of the dream they're imagining in their head. They're thinking Bitcoin's $100,000. Maybe Dogecoin can go to $100,000 and I'll own 10,000 Dogecoins. And so they're attracted to garbage over quality. And that's where, I always try to emphasize to people, like Warren Buffett said, it's better to buy a great asset at a good price than a good asset at a great price. You want the quality, not something that's cheap. Again, this comes back to things like speccing on single cards against buying good, high-grade, graded cards. If you want to have some reserve list card that you particularly love and you want it to be valuable in the future, you're much better off buying a single PSA 10 graded copy than you are buying a bunch of garbage damaged copies for the same amount of money. You'll make a better return off the quality item, even when we're literally talking about the same mechanical card. Your level one investors, they exist within the market. And the analogy I'm trying to make here is, if you think about, let's say you're in a crowded shopping mall, okay? We actually leave the house once in a while. We go to a crowded shopping mall, and we're standing there and there's just hundreds of people around us. That's how these people exist. They're in the market, and what they see are the other market participants around them. They look around, that's what they see. They never really think about going up to the second level and looking down at all the participants and figuring out how all those dynamic groups of individuals negotiate walking through each other down below. Instead, all they see is down at floor level of themselves and these other people that they're in the market competing against. They're just trying to figure out how to operate within the market. Mechanical things like buying and selling, limit orders versus market orders. Hopefully not basic options at that point. God help them if people are getting into stuff like that at the point where they're still level ones. But they tend to be unbelievably emotional, and kind of with good reason. This is something I mention a lot on this channel. To a great degree in America, we hate our jobs. Most of us have jobs we hate. We work there all week long doing things that we're not particularly enthusiastic about in order to make less money than we feel we deserve. We then pay taxes and insurance and rent and car notes and food and everything else. And if we have a little bit of money left over, we might invest it. And to see that value of those investments go down is a very emotional thing for your level one investors, because they're just at that point where they're starting to invest and they see, oh my goodness, it lost 5%. And they can have a very strong emotional reaction to that. And the example I always give is people I've known in life who sold positions in high quality blue chip companies because the stock went down 3% in one day. They panicked and they sold. They sold things like Coca-Cola or Walmart or Exxon, all these great companies, because the stock went down 3% in one day. They're very emotional about things. They're dazzled by the short-term noise, and really they're the type of people that the financial press is made for, that it really targets. They will read articles based on clickbait titles. They will believe everything they read in the financial press. It's who the financial news channels are really made for. People who kind of combine that as entertainment with gaining knowledge. And they think that every single thing they read is going to be important to whatever market they're in. For the most part, you can ignore that stuff. And I talk about that a lot here, that most of the information about a market is useless nonsense that won't matter 6 months from now. You know, if, and this was really bad in years past, but Elon Musk would make tweets about what was going on at Tesla, or he would make some silly tweet and Tesla stock would move based on it. And I would always talk to people about this, and I would say, are we actually supposed to think that 10 years from now, the value of Tesla as a company is dependent on what Elon had for lunch today? Obviously, the answer is no, but your low-level investors will hang on all that short-term noise because they think that all information is valuable information. They like to nitpick over tiny details that don't actually change anything. I've encountered this a lot. I've had people respond to things on this channel and make comments like, well, Craig said it was 26, but it's actually 24. You can't trust anything this guy says. And I'm sitting there thinking, you know, it doesn't matter if it's 24 or 26, the main thesis remains the same. But your low-level investors will think that this shows their superiority, their knowledge, their attention to detail if they nitpick things. And so that's often a way to just say, man, maybe that person is not worth listening to if they're nitpicking some detail that doesn't actually create some kind of actionable difference in what you might do in the future. And lastly, for your level one investors, they're the ones who will engage in shit posting and arguing on financial forums because they think there's honor to be had in being right. They think they're going to convince people of the superiority of their views, and they think it's worth their time to argue over this stuff on the internet. So now we get into our level 2 investors, level 2 out of 3 levels. And the thing that really defines these is that they will tend to be a little older, though not always, but I have never met a 25-year-old level 2 investor, I'll say that. They tend to be more experienced, both in markets, in business, in the world itself, and most importantly, they tend to have survived at least one market cycle. And this is something that Rudy talks about when he actually talks about data of turnover on his Patreon program, that most of the people won't be around for the next cycle. Most of the people who are there now were not around for the previous cycle. So most people never see the entirety of a market cycle to understand how things really work. Level 2s will understand that you don't just want to make money, but you're also trying to optimize the time value of your money. And I saw a really great video that the algorithm suggested to me about a week ago. Is from some gentleman I had never seen before, and I don't remember his name, but he had a small Pokemon finance channel, and he was kind of giving some advice, and it was really great because you could see that he was at that level too. And the overall theme of the video that I watched from him was, now's probably not a great time to buy Scarlet and Violet era product because we're probably near the top of the cycle. And he kind of talked about how you saw the same thing back with Sword and Shield, and the market came down and it was in bear mode for many years before it finally came back up. And so he was just kind of trying to say, hey, there's probably going to be a generally better time to buy in the near future. The one conceit there, of course, is that eventually you will learn that trying to time those things, trying to say, well, it feels like the top of the market. Yes, it may, but you probably don't need to change what you're doing based on that. And that's coming later. But your level 2s will understand that there are some big underlying theses that you can latch onto. And like this gentleman in his video, basically, don't buy at the market highs. And these theses are kind of dangerous because it turns out a lot of them are wrong. Okay, so they're learning those kind of rules and theses, and these are things that get bandied about a lot in comment sections and financial press articles. And at first, when you're in kind of this level 2 area, they sound really smart. They sound like the compiled wisdom of past generations, and like something that if you just grab it and start repeating it, you'll have more success. And eventually, when you get to level 3, you'll realize that a lot of them are wrong. There are some good ones, like I already said, buy great assets at a good price instead of good assets at a great price. But there are a lot of bad ones. And here's where I'm going to gore some sacred cows. The idea of intrinsic value, it's garbage. I've made videos about that in the past. I'll make more in the future. But it's a distraction, and it does not give you any type of actionable information. The idea of organic collectability, I made a whiteboard video about that a few months ago. That's another one where anytime someone tries to explain organic collectability to you, you can just sit there and poke hole after hole after hole in the argument. There is no such thing as organic collectability versus manufactured scarcity. It is all manufactured scarcity. It does not matter. There's the cult of cash flows, people who get so emotionally hung up on the idea of cash flows having this special kind of value in the market. I will make a video specifically on this in the near future. It's one I haven't really talked about in the past. And lastly, kind of the bad rules to point out, don't catch a falling knife. It's one I talk about a lot. Catching a falling knife is how you make the most money in a market. But don't catch a falling knife sounds really intelligent because it's this analogy that you can immediately picture as a person reaching out and trying to catch a falling knife and getting stabbed through the hand with it. Of course, the problem with it is they will say, don't catch the falling knife, wait till it hits the floor and then pick it up off the floor. Of course, extending the analogy that you should wait until a market bottoms before you buy, and engaging in the conceit that you can tell when the market is bottomed. Of course, that's the problem. You can't tell. So people in this level 2 here will generally start believing some of those bad ideas and those bad theses. So they're not yet to the point of critically examining those theses themselves, refuting some of them, and coming up with their own. They still think they can time tops and bottoms. And that comes back to the gentleman with his Pokemon video where, he is trying to be helpful. It is good advice, kind of. But, don't buy at the top. Okay, that's sound advice. We'd all love to be able to follow it. But eventually you will learn that you don't know when the top is. Often, some of these people, and here comes another sacred cow, often they've discovered technical analysis and charting and candlesticks and heads and shoulders and all of these things that are essentially just the Invest Bros version of astrology. But man, the number of articles that I see on Seeking Alpha of people doing technical analysis on something, and they're just drawing lines all over back and forth on a chart and saying, oh, well, these lines are converging, so it means it's either going to break out high or break out low, or maybe it won't break out at all. So often they can get sucked down into the trap of technical analysis at this point in their investing career. In general, though, at least going back to the analogy of someone at the shopping mall, these are people who have at least climbed up to the second level of the shopping mall, and they're looking down and trying to see the market as a whole. And kind of that parallels the idea of self-actualization as you grow up. You know, when you're a little kid, you have thoughts in your own head and you interact with the world. And at some point in your life, you realize other people have thoughts in their heads too, and they interact with the world. And then at some later point, you realize all these people having thoughts in their heads and acting on them create the world that we all interact with. And then there's several more levels of self-actualization on top of that, but it's kind of like that. It's kind of like you've pulled back from being stuck down at the bottom level, looking around and seeing the other market participants, and you're actually looking at the whole market as its own organic thing. They are starting to understand the short-term versus long-term nature of the market. And like I said, generally your level 2 people have survived at least one cycle in the market. And so they can understand that maybe on the long term, markets tend to go up. On the short term, markets can go down. We can have recessions, we can have bear markets. A company can report bad results for a quarter and its stock can be down compared to the rest of the market for a while. But they're starting to understand short-term versus long-term nature of the market. And even ideas like, I like to say, on the short term, markets are a voting machine, and in the long term, markets are a weighing machine. The idea that markets can be more irrational on short time scales, and they will tend to be less irrational on long time scales because the amount of money required to maintain that irrationality becomes too much. This is also level 2, where you have what I call the doomer trap. And of course, doomers are the people who will tell you every year, and in fact, every year of my adult life, I have been told that the financial end is coming. The economic destruction of America, of the world, of the dollar, of whatever, is here. Every year for the last 20 years, I've been assured so many times by the doomers that it's all going to end. And the doomer trap is here at level 2 because they've kind of looked around and they've seen some of the short-term, long-term nature of the market, but they become convinced that the apocalypse is nigh. And it's really unfortunate and sad because having known some doomers in real life, they vastly underperform the market because they'll do things like get spooked and go completely to cash and miss out on a lot of market appreciation. They'll get spooked and they'll trade all their stocks out and they'll go completely to gold and they'll pay all these fees to do that. Gold will then go down. They'll lose money overall and they'll miss out on market appreciation in stocks. Or they will just not engage in normal, sane investor behavior like, dollar cost averaging, buying a little bit every week, buying index ETFs, not fiddling with your accounts all the time. They'll miss out on stuff like that because they still let too much of that short-term noise in and they become doomers thinking that it's all just going to fall down. Not every level 2 becomes a doomer, obviously, but this is the spot where some people will turn into perma-doomers. And when it comes to arguing on financial forums, these are the people who will try in good faith to convince other people of their views. They're still arguing on financial forums, they're still having disagreements, but instead of just straight shit posting, they're at least trying to convince people, hey, the dollar is about to fail finally because of this, or the whole US economy is gonna, go into recession, we're gonna have 100 million unemployed because of this. And they'll really try to convince people in good faith. Okay. So now we get to level 3. And You know, the thing that defines level 3 is often it's people who are older, are very experienced in markets, sometimes multiple types of markets, say real estate, stocks, crypto, TCGs, whatever it is, whatever you're into. They may have experience in multiple of those markets. They've lived through several cycles. They've been successful at it. And so it changes your philosophy. Once you've had success in markets and you've seen how things work for 10 or 20 years, it changes how you think about markets and about your participation in it. And so one of the biggest differentiators is they no longer think in terms of how much money can I make or can I time the market. They think in terms of what's the upside potential versus the downside risk. And so for every bet, they're going to be weighing what's the potential upside versus the potential downside. And so in net, do I think that the total upside potential is this much and the downside risk is this much? And when I take the difference between those two areas, it has a net positive probabilistic outcome. If so, then I may take the bet. So they're looking for those bets with favorable probabilities. They're not looking for bets like, well, I could spend $1 on this lotto ticket and it could pay out $1 billion. They don't look at it from a standpoint of what's the number of dollars. It's about odds. It's about probability weighted returns. So they speak in terms of probabilities, distributions, ranges of outcomes, things like that. And there's a lot of hedging language in our speech when we get to this level. You know, I talk a lot about, like I mentioned recently with Innistrad Remastered. I said that I think there's a better than 50% chance that Innistrad Remastered collector boxes at 1 year are higher priced than Ravnica Remastered collector boxes were at 1 year. And to some people, to less experienced investors, that sounds like a lot of weasel talk. Like I'm not willing to make any exact predictions. And you're damn right. I'm not going to make any exact predictions because I've been in markets long enough that I know exact predictions are not useful. You deal with distributions of possible outcomes, not exact predictions. So at level 3, you understand that timing the market is a fool's errand. I actually read an article on Seeking Alpha this morning where the author criticized a hedge fund manager for not timing all of their purchases at the bottom of the market. And he did it unironically. And, you know, I sat there and I thought, man, this writer thinks that this person he's talking about should be timing every purchase to be at the bottom of the market. When you've experienced several market cycles, when you've accumulated some wealth, when you've made some good trades and a lot more bad trades, you understand that timing the market is just silly. Even right now, where Pokemon looks like it's probably past its peak, Scarlet and Violet era bull run is probably past its peak. Even so, maybe it's not. Maybe we're going to take another big leg up here for another 6 months. So even seeing the data that I have right now, it's difficult to want to say, yes, we are past the peak and we are on the way down. The same thing when it comes to the bottom of the Magic market on Black Friday of 2023. It was 6 months afterwards before we really conclusively said, yeah, that was the bottom. It took a long time afterwards in order to look back at all the data and say, that really was the bottom. So you have clear theses proven out over time that have predictive power. I talk about mine sometimes on the channel. One of the big ones is, in general, markets continue to go up, and I think they will continue going up for the rest of my life. I don't think we're headed for some kind of situation where for 20 years markets remain below their previous all-time highs. And so you've gone through all of those kind of smart sounding adages from level 2, catching the falling knife and intrinsic value and all those things, and you've evaluated them critically yourself, and you've discarded the ones you've decided are not true, the ones that in your experience have proven to not be true. And you've probably added some of your own new unique ones on top. You understand at level 3 that details rarely matter. It's the big picture that's important. You know, whether I buy a box for $108 or $111, it does not matter. It really doesn't. You know, maybe if I'm buying something and I can get it for $100 less and I'm buying 100 of them and I'm saving $10,000, even then it's hard to get excited over the idea of that. Because the reality is you have to make that decision to buy or sell at every moment. Am I going to buy at this moment at 110, or am I going to wait and hope I get it at 108? Those kind of details don't matter in the long term. You know, when you're looking at long-term Pokemon prices and the boxes tend to appreciate 15, 25, 35% per year, year over year over year over year, you really don't care if you're buying a Surging Sparks box at 235 or 215. It's not a big deal. And so you become more relaxed about all of those small details. You've discarded the common knowledge that is wrong. I've already talked about this one. You've discarded technical analysis completely. There's nothing to be gained from technical analysis. It has no predictive power. And the best argument I've ever heard someone make in support of technical analysis from, you know, a level 3 perspective is that you might use it to predict what other less sophisticated investors might do if they're relying on technical analysis. Even then, I think there's probably not much actionable value that you can get out of it. At level 3, you realize that most of the writers and the financial press are trapped at level 1 and level 2. And like I said a minute ago, the article I read this morning where the writer was accusing a hedge fund manager of not timing all his purchases at the market low. And, you know, you could tell that the writer of that article was inexperienced and just lacked overall awareness of how the markets work in the long term. There are vanishingly few level 3 investors writing articles. And part of the reason is you decide you just don't want to argue with people anymore. You decide that most of them are not ready to be brought along. Most of them lack the experience to immediately come up to level 3. They have to do what I did over the course of 15 years. You have to slowly move up through the levels as you gain more experience. And so I read some things about a particular stock last week. I was talking to my dad about it, and I was explaining to him how, like, there were all these people in the comments section who essentially did not understand the objective way that this stock worked. And so they were making all these claims about the stock that were objectively wrong. And I thought, you know, I could sign up for Seeking Alpha and I could write an article that laid out the math model for how this transaction works and then what the potential outcomes are. And I could write an article that completely explains to these people how that works. And I told my dad that then I realized, like, if I did that, I would waste many hours of my time. Most people, even confronted with the objective evidence, would not be swayed. And I would make $2 or $3 from publishing an article on Seeking Alpha. And I told my dad, you know, what it would take is Seeking Alpha would have to come to me and say, here's $3,000 to write this article. And then I would do it. But there's no payoff. And often when you're experienced enough in investing and in markets, you realize that there is no payoff from trying to educate everyone. Not everyone is willing to come along. Some people are still so caught up in shitcoins and penny stocks and technical analysis and intrinsic value and organic collectability and things like that that they cannot be pulled along. Some can, but not all. And so you lose your will to try to educate all of those people. And instead, you do what I did. I started a Patreon program, and I said, if you want to come along, if you want to advance, if you want to improve in your abilities, then you can join the Patreon program and then I will work with you. And that's very rewarding because the people who join the Patreon program are the ones who want to learn, who want to get better, who want to improve. Some of them are already definitely level 3s when they come on board. I mean, there's no doubt about that. But, instead of me trying to help everyone who just wants to shitpost on YouTube, I can narrow that group down and focus my effort on the people who want to be there. And so that's why you find very few level 3 investors writing articles in the financial press. And why, when you do find one, it is an absolute gem and you look forward to their writing. So at level 3, you also understand that making money slowly with minimal risk is very easy. You buy index ETFs, you auto deposit some of your paycheck every week into your 401k. You don't buy and sell trying to time the market. You basically do very little. You set up auto deposits, auto purchases in index ETFs, and you leave it for 20 years. And then you look at the wealth you've accumulated, you extrapolate it out to retirement, and then you decide what you want to do from there. You know that, making money, just did that one. You're patient as the pyramids. And that's something that's really hard to teach. Some people just naturally will never know patience in their life. I was, from some perspectives, fortunate and some unfortunate. I was born with a personality where I can take a drink of a soda and sit the soda on my desk and ignore it for an hour and not take another drink and not feel bad. I have an open box of booster packs here of an old superhero card set from the 90s that I love, and I have not opened one of those booster packs in over 2 years now. I am patient to the point that it makes some people uncomfortable, and that's something you have to learn. It's something that will definitely improve your returns as an investor if you will just be patient and ignore everything else. We had the announcement of tariffs, what's it been, like 6 or 7 weeks now? And the market dropped, I don't know, it was like 10 or 16% or something. And then it's mostly back from it. I did nothing. The market dropped, I did nothing. The market came back, I did nothing. And thus, I lost nothing because I'm patient. It didn't matter. One of the things that you realize when you get to level 3 and you've had some success as an investor and you've seen multiple market cycles and you have confidence in the way markets work and your understanding of them, you realize that even during bear markets, even during recessions, even during large market drawdowns, you are still wealthy. You're still doing great. You still have all these assets. And so you just don't worry about things. You don't worry about, oh, well, we're due for a recession, or, the dot plots say this, or, the odds of recession given by whoever reports them is up to this or down to that, or unemployment numbers are ticking up or down. You don't worry about those things anymore. You don't worry that, well, what if the S&P 500 gives up 40%? Okay, I'll still own the same number of shares of S&P 500 index ETFs, and the market will eventually come back. And so there's no point in worrying about it. And so it's almost a Zen-like state that you take on after you've been investing long enough, after you've been patient enough, after you've had some success, and you've accumulated some wealth. You just don't worry as much. And that's one of the big hallmarks. Instead of the level 1s running around worrying about Dogecoin or some penny stock or whatever being up or down $1 or 10 cents or a fraction of a cent, instead you probably only check your investment portfolio every 2, 3, 4 months. It's just not a big deal. It's not something you worry about. And really, you become emotionless about investing. And that's a very good thing. It sounds heartless and awful maybe to some of you, but it's a good thing to be emotionless about it. When you're emotionless, you're not going to panic and sell at the low. You're not going to buy into an upward trending momentum trade that then falls off like a cliff. You're not going to make as many bad decisions if you're emotionless about this thing. If you simply have a plan, you stick to it, and you don't deviate regardless of what the market is doing. You just don't worry about it because you know that your bets will eventually work out. You've seen enough market cycles, whether it's TCG market cycles or stock market cycles or anything else. And lastly, for level 3, you never even post on financial forums because it's not your job to educate all of those people. You understand? A great majority of them have to learn through experience. Only some of them are willing to learn through education. Now, having gone through the 3 levels, there's something else to say. It's an unfortunate reality that there's a positive feedback loop going on here between moving up the levels. If you are predisposed to be patient, to be unemotional, to set weekly deposits from your paycheck into a 401k, to accept that index ETFs are going to give your best long-term returns. If you're predisposed to all of that, you will accumulate more wealth earlier in life than people who are predisposed to be hyperactive, to be very emotional, to want to trade in and out of positions a lot. And so you will do better. But the positive feedback is then you will kind of gain that enlightenment into level 2 and eventually level 3 earlier in life. And that will compound into more success. And a lot of this will sound really easy to you. Maybe if you were on that path in your life and your experience, and now you're in your 40s or 50s, you've spent the last however many minutes looking at this video and just nodding your head and grinning at everything I've said. But if you're on the other side, you're impatient, you're emotional, you always think that you're smarter than the rest of the market, you will have lower investment returns. You will probably have overall negative investment returns, and that will make you more panicky. That will make you more emotional because you've seen some of the money that you traded your pathetically short life for at a job you hate evaporate in investments that didn't work out. And that's going to make you feel like you are more behind and you have to take more risk if you ever want to catch up. And so you will make worse and worse decisions that leave you further behind longer and longer. And so that's the unfortunate positive feedback loop that happens with this. More wealth, more patience, less worry, less risk that you take on, and better returns. And the flip side is if you have less wealth, you will tend to be less patient. You'll have more panic at market movements. You take on more risk, and overall that causes you to have worse gains. Most of the advancement through these levels is from experience and age and wealth gain. And it's difficult because you can be taught some of it. You can be taught more or less depending on your personality and how receptive you are. But a lot of it is just requiring that you take the time to experience some market cycles and to learn enough. So you cannot force yourself to start off at 22 years old and have a level 3 mindset about investing. Only some of this can come from study. And a lot of what comes from study is more the nuts and bolts things of markets. How do options work? How do bonds work? How do credit spreads work? How do convertible bonds work? How does this and that? The actual mechanics of the market is the stuff that you really gain through study. But the harder, more difficult lessons you gain from losing money. There were a lot of times when I did dumb things in the mid to late 2000s as a level 1 and I lost money. It took time and it took loss for me to learn from it. And then I spent most of the 2010s into the mid to late 2010s as probably in that level 2 zone where I had learned a lot, I was refining things, I was becoming more patient, but I was not fully developed. I still believed some of the dumb adages that you read on financial forums. And it was not until the late 2010s that I really moved into level 3. I kind of got to the point in my life where I had gained enough wealth that I realized I don't need to take as much risk. I can be more patient. I can trade less. I can take on a lot less risk and have higher returns. Your big theses will often have to come from yourself. And that's a difficult thing because some people are better at others with coming up with the big ideas, with seeing the big ideas, with having the eureka moments where they can distill them down into something that's easier to understand. And I've been fortunate that the way my brain works, I can sit a question on the back burner of my brain and contemplate it for weeks in between other tasks, in between thinking about other things. And eventually, I will have some kind of realization that helps me break through on the question and understand things better. And I know not everyone is like that. So the best thing you can do to move up in levels is try to be more patient. Try to do less. Trade less. Buy less. Sell less. Just set your accounts for auto deposits and auto investments and index ETFs and don't think about it. Because the more you do, the more you panic, the more you jump in and out of markets, the more you try to time things, the worse your outcomes are going to be. So the best thing you can do is less or nothing. Have a plan and stick to it. Be unemotional, like I always say. That will grow your wealth and increase your confidence and make you less worried until one day you come to the Zen-like state like my dad is at, where the market goes down 10% because of tariff announcements. And he says, well, I still got my auto deposit of income out of my brokerage account. And so he doesn't care. He is at that Zen-like state. And so one last analogy to maybe help how to think about the distinction between these three levels. I thought about it and I thought of another analogy. And you could think of level one investors as like athletes playing in a sport, right? You try to be the best field goaler or whatever that you can because you're an athlete who plays on the field in the sport. Your level two investors, those are like team coaches. They're trying to optimize strategy overall to win the most number of championships over time. And your level three investors are like people who are contemplating the evolving metagame of the sport itself. They're looking at changes in strategic trends over time and thinking of it in that level, zoomed out, looking at everything else. And so they are far removed from that kind of tactical position of the athlete on the field, and they think about it in different terms. So hopefully no one's too upset that they abandoned the video partway through. I know videos like this where I gore sacred cows of investing tropes, I always get my highest number of downvotes on these videos, and it's like, that's good feedback. That tells me I'm doing it right. Because when people feel like their core assumptions about how the world works have been challenged, they'll get upset and they'll downvote the video. And so it's always these kind of videos where I talk about intrinsic value or catching the falling knife or technical analysis being the Invest Bros version of astrology. Those are always the videos I get the worst feedback on. So I know I'm doing it right. So let me know what you think. If you have any questions, join the Patreon and message me. And thanks to everyone who makes this content possible, especially those very generous supporters on Patreon. Thanks, guys.